Thanks so much for tuning into this earnings conversation with Mr. Bharat Puri of Pidilite. The numbers, by their own standards that they set out, may be disappointed a touch bit. The question is, as some of the corporates have said, is it possible to predict whether this is the end of the tumultuous period for input cost, or does it still last? And also, with consumer sentiment in India strong, but the rest of the world not as, how does he think the second half of the year could shape up? Mr. Puri, good having you. Thanks for joining in.
Always a pleasure, Neeraj. Always a pleasure to see you.
Thank you so much. Likewise, sir. So first, let's start off with how you thought the quarter was, because when I looked at the numbers on the revenue front, right, volume growth in the consumer business, for lack of a better word, seemed a bit muted. Was it seasonal in nature, or is there something else to this?
No, actually, as far as growth is concerned, my invitation would be, rather than look at it as a quarter because of shifting dates, last year being an unnatural year, I would look at the half, and I would then actually also look at CAGRs over a 3-year period, including the pre-COVID period, because, then it gives you a good idea if you're making substantial progress or not. If you look at the half, obviously we are tracking well. Our value growth is about 34%. Our volume growth is in excess of 20%. More importantly, if you look at our CAGRs, over a 3-year period, both are in high teens in a value and a volume sense. So, you would see, therefore, compounded, we're making steady, in fact, good progress pretty much at, 2.5 times GDP, which is above the objectives we've set ourselves. So I would say at an overall growth level, we're not worried. The good news is that we're beginning to see light at the end of the tunnel on the input costs.
Okay.
Input costs, as we have mentioned in the past, have been unprecedented. Our principal raw material, VAM, which is vinyl acetate monomer, was ruling at a price of $2,500 a ton against a normal price pre-COVID of less than $1,000 a ton. The good news is that we're beginning to see moderation there. Softening, prices are down to between 12 to 1,400. So in many ways, quarter 2 will probably be the highest material cost.
Okay.
Quarter 3 will see some reduction, but you will still be carrying a lot of the inventory of the high-priced material. Quarter 4 onwards, hopefully, and these days one is very hesitant to make predictions because you don't know what new black swan event is going to happen. But if things remain normal by quarter 4, I think we will come back to our normal margin range, and therefore also return our focus back to our original objective of profitable volume growth.
Got it. Yeah. Okay, I was going to come to that. So, so since you brought margins up, let me finish that and then I'll move on to the other pieces. Should things not become normalized as quickly, not from a perspective of geopolitics, but in perspective of supply chains issues that might be still there, would you forsake volume growth in order to protect a particular level on the operational front, or you don't think such a need would come?
In our opinion, that need won't come. We've actually done that. If you see in the last 2 quarters where we have sacrificed margin because we believed that these prices were unrealistic and we would actually reduce margin but not tax the consumer, and we've been vindicated, prices have come back. So frankly, we don't see that happening in the future. I mean, yes, there will be some ups and downs, but hopefully not of this unprecedented nature as we've seen in the last 12 to 18 months.
Got it. And therefore, would it be safe to assume that maybe you have taken some price hikes in the first half, if you will, in order to mitigate some of these costs? But would there be a need for any further price hikes as things stand in the second half?
No, we don't see any need for any further price hikes. In fact, if the trend on prices continues, we would even actually look at reduction in prices, because finally, in any emerging market, we believe that inflation is the biggest tax a consumer pays. But given the current situation on input costs, we don't see any increase in prices happening in the near future.
I get the drift. Two questions. One, actually, let's take step by step. On the demand front, as is for a bunch of other companies, I guess for you as well, urban grew much better than rural. Now, the thing is, Mr. Puri, I've heard mixed commentaries from companies about whether rural can come back in a meaningful way starting quarter 3 itself. HUL may have said it would. Some of the others have said they don't have a handle on it. What is your sense?
See, just remember that for our sector, the home improvement sector, a large part of rural and semi-urban is also about educating the consumer and new consumers. So when we compare, remember, when again I look at my rural growth, unlike the FMCG companies who've actually declined volumes, we have not declined volumes. We are still, even on a CAGR basis, we are growing volume steadily. The only thing is, traditionally, we've always wanted semi-urban and rural to grow 1.5 times urban. That has come back to normal, in fact, at times below urban. Now, in our view, two things. One, as inflation moderates across the board, hopefully that will put more money in the hands of the consumer. Secondly, hopefully the good monsoon, other government measures to actually put money back in the hands of the consumer should see in the next 3 to 6 months some amount of revival as far as rural and semi-urban is concerned. So we remain cautiously optimistic. Right now, if you look at the tailwinds in our sector, real estate really has definitely come back, especially in the organized sectors in the bigger cities. Construction activity has substantially increased. Post-COVID, there is a complete change in the consumer's mindset towards the home. The consumer is now wanting to invest in the home before anything else. And obviously, we're beneficiaries of that. The headwinds, if you ask me, is still that, yes, inflation has been high over the last 12 months, and while it may moderate, it is still high. The second is the point that you mentioned right in the beginning. We cannot decouple ourselves from the rest of the world. We are finding, for example, wherever we have exports to the developed markets, which we have, for example, in our B2B businesses, we're finding already some amount of order cancellation stroke order pullbacks. Customers of ours who are in the export business are also finding their business getting challenged. So there will be some impact of the global situation. I don't think it will be substantial, because obviously for us, domestic demand is a far, far greater driver of growth than is international demand. And therefore, as long as GDP grows, as far as India is concerned, we've always said we will grow 1 to 2 times GDP. And our focus will be back on growing volumes profitably.
Sure. Okay. Any market share gains during the quarter?
See, during the half, definitely, if you look at, as I said, if over 3 years we have actually grown, mid-teens in volume, obviously the market has not grown at those rates. So clearly we have gained market share over the larger period of time. As leaders, frankly, our focus also remains on growing the market rather than only on market shares. And that's where we keep focusing on. So we're happy with the pace of progress we are making across, whether it's our core categories, the growth categories, or the pioneer categories.
Yeah.
Just to give you a perspective, in the last 3 years, 20 of our plants, we have expanded substantially, brownfield plants. We've put up 11 new plants. So in many ways, we're ready for the next phase of growth, the next phase of the India consumption story, with our supply chain already in place.
Yeah. Actually, I was going to ask you that question. A bunch of companies in the home improvement space and in the suppliers to the real estate category are all putting up some serious capex over the course of the next 3, 4, 5 years to take advantage of what is perceivably a long-lasting real estate cycle. By your previous answer, are you saying that you are already, by virtue of the capex that you've done, ready to do that, or do you reckon that you might be in the throes of planning some further serious capex, because you too, Mr. Puri, have entered into a clutch of either you can call it adjacencies or pioneer categories, as the case may be?
No, we will continuously keep doing that. We've always guided that, listen, we will keep moving into adjacencies and increasing the total addressable market for Pidilite. In the last 3 years, if you see tile adhesives, you see tile grouts, you see marble and stone glues, and like this, you will see pretty much every year 1 or 2 new categories. That will continue happening. Our core, obviously, we keep investing in. But as we've said, we like to invest ahead of growth. While everybody else was buttoning down the hatches during COVID, we were the only people who were expanding and getting ready. And, we realized that supply chain is going to be an advantage going forward. And the old adages or the old constructs of supply chain need to change, which we've actually actioned fairly well in the last 3 years.
So therefore, Mr. Puri, my final question on this conversation today. One, maybe a bit of a repetition of what you said, but one, how do you see the second half, part one? And part two, how do you see growth numbers shaping up over the course of let's say, the next, say 2-3 years? The reason I bring up this question right now is that in the last month and a half, we've heard a bunch of people talk about how the China plus one and Europe plus one opens up opportunities in a massive fashion for job creation in India, which would all lead to large real estate demand, large home improvement demand as well. And if indeed India GDP grows, even if the world doesn't, there is a natural demand for all consumer facing companies, including yours. So how do you see the growth trajectory for the second half in terms of some numbers, if you can, and for the next few years? I know you mentioned that it's a mug's game right now to try and predict the future, but I'm still egging you to do that.
See, we've always said we are strong believers in the India consumption story and the India story. The fortunate thing in our sector is we're frankly in the right sector. If you look at the housing stock that has to be built by 2030, 70% of it is still to be built. Then you're seeing all of the, shift of manufacturing, the China plus one, Europe plus one, as you put it, so on and so forth. So overall, while, we've always said that, listen, we are strong believers in the India story. India remains our core market, and we will keep investing ahead of the curve in India, and that will keep happening. We estimate as GDP keeps growing, as I said, when construction is good, we go closer to twice GDP. When construction is challenged, we are closer to once GDP. Okay. That's going to be our focus. Keep growing volumes. Make sure that you have, the pillars in place. So be it digital, be it innovation, be it your whole people piece, and obviously your supply chain. Make sure that all of it that is there and be ready for the next phase of growth.
Great. Well, hopefully at the end of the quarter three, we'll have some telltale signs of the input cost pressures completely abating, and there being good times in quarter four on the margin front. And may the rural sector as well come back with a bang, Mr. Puri.
Thank you. Thank you so much. Always a pleasure, Neeraj.
Likewise, sir. Thanks so much for talking to us, and viewers, thanks for tuning in.